Hi friends, welcome to Everstudy Classes. So in this video we are going to continue our discussion on the past 5 MCQ series which we have started for UGC Net Commerce Examination. So as a part of this series we are regularly discussing 5 important MCQs which have been asked in the past year papers and which have a very high probability of being repeated in the future also. So that's why we are covering all these questions in a very holistic and comprehensive manner. The topic for today is going to be financial accounting. Now before proceeding to our discussion, let me quickly tell you about the courses which the Everstudy Classes is running for UGC Net Commerce. Now we are running both free as well as paid courses for UGC Net Commerce, and in the free courses we have a free mock test which is a computer based test on the latest pattern and on the latest mode which is going to be employed in the UGC Net NTA examination. So you can appear for this computer based test and get a feel of what it is going to be like when you appear in the final examination. Also, we are having a past year analysis discussion section in which we are regularly discussing past year questions, and this particular video is also part of that series, and all the PDFs of this series are available in this course of ours. And also we are running unit wise glossary, and in this particular series we have a unit wise glossary in which we have picked up important terms from each of the units, and we have written them in a very simple manner with proper examples and proper diagrammatic presentations so that you can grasp these terms in a very comprehensive and a very easy manner. Now apart from our free courses, we are also running these paid courses on test series for UGC Net Commerce. Now we believe that a practice makes the man perfect. So we believe that you should practice as many questions as possible, and these questions should be based on the UGC pattern and they should be based on the same mode in which you are going to appear in the final examination. So for this particular purpose we have provided you a computer based test series, and we have two set of test series. One is a full length mocks test series in which we are having 6 full length mocks for rupees 499. So these test series will have 600 questions and they are going to be based on the latest UGC Net pattern, and you are also going to get detailed solutions with explanations, and in case of any query you will always have the faculty support with you. And in the other course we are having a complete test series in which we are offering 12 unit wise tests of 100 questions each and a 6 full length mock test also containing 100 questions each. So you will have a total of 1800 questions in this test series, and they will also be on the same lines. It will be a computer based test. You will get the detailed solutions and faculty support, and this one is priced at rupees 999. Now before proceeding to our discussion, let me quickly tell you about the courses which the Everstudy Classes is running for UGC Net Commerce. Now we are running both free as well as paid courses for UGC Net Commerce, and in the free courses we have a free mock test which is a computer based test on the latest pattern and on the latest mode which is going to be employed in the UGC Net NTA examination. So you can appear for this computer based test and get a feel of what it is going to be like when you appear in the final examination. Also we are having a past year analysis discussion section in which we are regularly discussing past year questions, and this particular video is also part of that series, and all the PDFs of this series are available in this course of ours. And also we are running unit wise glossary, and in this particular series we have a unit wise glossary in which we have picked up important terms from each of the units, and we have written them in a very simple manner with proper examples and proper diagrammatic presentations so that you can grasp these terms in a very comprehensive and a very easy manner. Now apart from our free courses, we are also running these paid courses on test series for UGC Net Commerce. Now we believe that a practice makes the man perfect. So we believe that you should practice as many questions as possible, and these questions should be based on the UGC pattern and they should be based on the same mode in which you are going to appear in the final examination. So for this particular purpose we have provided you a computer based test series, and we have two set of test series. One is a full length mocks test series in which we are having 6 full length mocks for rupees 499. So these test series will have 600 questions and they are going to be based on the latest UGC Net pattern, and you are also going to get detailed solutions with explanations, and in case of any query you will always have the faculty support with you. And in the other course we are having a complete test series in which we are offering 12 unit wise tests of 100 questions each and a 6 full length mock test also containing 100 questions each. So you will have a total of 1800 questions in this test series, and they will also be on the same lines. It will be a computer based test. You will get the detailed solutions and faculty support, and this one is priced at rupees 999. So friends, let's start with the first question. Which one of the following is not correct with reference to standard costing? So this question is based on the concept of standard costing, and it is asking which statement is incorrect with regard to this standard costing. Options are: standard costing is a system where predetermined costs are used for control of entire organization. Standard may be expressed in quantitative and monetary measures. Only adverse variances are investigated intensively. Standard is determined for each element of cost. Now, before proceeding on to what this concept is about and what is the answer to this question, let me quickly just tell you that whenever any option it contains a statement which says only, then this kind of statement it restricts the scope of that particular statement. So in that particular scenarios, there is high probability that this can be your answer if it is asking about the incorrect option. So let's look at the meaning of this term standard cost. Now standard cost is the predetermined cost. So this is the cost which is determined in advance, and it is calculated on basis of the management's standards of efficient operations and the relevant necessary expenditure. So the management, it is fixing certain standards of what should be the cost for any particular quantity of output. So on the basis of that particular standards, we are fixing this standard cost. Now in standard costing, what we are doing, we are basically comparing the actual cost with the standard cost. Actual cost means actual cost of the goods that were produced. So if you were producing, say, laptops, then you would consider the actual cost of the laptops which were produced by you, and you will compare it with the standard cost, which is the cost that should have occurred for those laptops. So we will use some formulas, we'll apply some standards, and we'll find out what should have been the cost for producing those laptops. So this is going to be the standard one, and the actual is the actual cost. So we compare these two costs when we talk about the standard costing, and we try to analyze the differences which are variances between actual and standard costs. Now standard is determined for each element of cost. So there are different element of cost like material, labor, variable overheads, fixed overheads, etc. So here the standard we are determining for each element of cost. We are determining for material, we are determining for labor as well as overheads. So even for these elements of cost, we are also having certain sub elements like material usage we are considering, material price we are considering, again labor efficiencies there, and labor rate variances there. So we are considering different elements, and we are not just restricted to broader scope of these elements. We are going deeper, and we are analyzing each of these elements in much detail. Now when we analyze the standard with the actual cost, there can be two sides of variances. One is favorable variance and other is adverse variance. Now favorable variance means when your actual costs are lower. So this is something which would make you happy, because the actual cost of the goods which have been produced, it is lower than the standard cost. So if the cost for producing the laptops was rupees 50,000 and you have produced it at rupees 40,000, then this means this is favorable variance. So this in a way shows the efficiency of business operations. So you have completed your work at a lesser cost, it means you are efficient. But then again, you cannot totally ignore these favorable variances and just stay happy. You have to analyze whether these favorable variance, whether the decline in the actual cost is actually true, is actually commensurate with the quality of the goods that you have produced. So for example, if you have produced a laptop for 40,000 but it's not as good in terms of quality, so in a way you are sacrificing your quality to get this favorable variance. So again, it becomes necessary to analyze these favorable variances. Next is adverse variances. Now when we talk about adverse variances, this means your actual cost is higher. So if the cost of producing a laptop actually is rupees 60,000 but the standard was rupees 50,000, this means that this is adverse. So it is a sign of inefficiency. It means you could not complete your task at the desired amount of money. So here you need to worry, you need to see what are the issues which are plaguing your production process and what are the necessary actions that you should take. So now friends, we can easily answer this question that the incorrect statement is going to be option number 3, which says only adverse variances are investigated intensively. So this is not true. Both favorable and adverse variances, they are investigated intensively. So option number 3 would be the correct answer. Now let's move forward to the next question. Which one of the following is not correct? So here we are given some of the formulas, and these formulas are based on marginal costing. So first is margin of safety, second is PV or profit volume ratio, third is break-even point in units, fourth is a required sales to earn the desired profits. So let us take a look at each of these terms and look at their formulas so that we are able to answer this question. Now when we talk about the margin of safety, then we are talking about the sales which are beyond the break-even point. So break-even point is the point at which you are not making any profits, and if your sales at this point they were rupees 10 lakh, then whatever you are selling above 10 lakh, this will be your margin of safety. So if your actual sale is rupees 12 lakh, this would mean your margin of safety is 2 lakh. So if this margin of safety is higher, then this means the financial position of the enterprise is sound. So this is very true and logical. Now when we talk about in terms of formula, margin of safety becomes total sales minus break-even sales. This is very logical. Now there can be another formula for computing this margin of safety, and it is profit divided by PV ratio. So this is another formula, profit divided by profit volume ratio. So this is the formula which we have to remember. So this formula is again going to give you what is your margin of safety. So when we are talking about the profits, it means what are the earnings which you have made. So when we talk about the earnings, then this means we are definitely above the break-even point. So whatever we have earned, it is more than break-even point. So it is actual profit minus break-even point profit. But if we divide this by the PV ratio, this would give us what the sales level at which which is the difference between the total sales minus break-even sales. So this is more or less this formula only. It's a different way of presentation, and you just need to remember this one. Now next is PV ratio or contribution ratio. So this ratio is association of two variables, that is contribution and sales. Now in marginal costing, contribution is the sales minus variable cost. So when we find the ratio of contribution to sales, we get this PV ratio. Now this PV ratio, it indicates the contribution the firm is making over the cost of that particular firm, or particularly the variable cost. Now when the cost accounting data is given for 2 periods, then the formula which is used for calculating PV ratio, this is change in contribution from one period to another divided by change in sales from one period to another. So this is the another formula. Next is break-even point, which is the no profit or no loss point. So at this point, the profit is going to be 0. And what you are going to do, this is very simple and very logical. So if your fixed cost is rupees 1 lakh, so this is something which you have to recover by your contribution. So if your fixed cost is 1 lakh and the contribution per unit which you are making is rupees 10. So this means that you would have to sell 10,000 units to recover this fixed cost, because 10,000 into contribution per unit is equal to 1 lakh, which is the fixed cost. So this is very logical. To find the break-even point in units, we consider the fixed cost and we divide it by contribution per unit. Next is sales to earn the desired profits. Now when we talk about the sales to earn the desired level of profit, we are simply adding the desired profit in the fixed cost. So this is very much similar to the break-even point formula, but in the numerator we are going to add the desired profits, and this is going to give us the sales value or the sales units. So friends, now we can easily answer this question, and that the option number 4 is going to be the incorrect one, because here the fixed cost is not being added to desired profit to calculate the required sales to earn the desired level of profits. So answer is going to be option number 4. Now let's move to the next question. Schedule 3, Part 2nd of the Companies Act 2013 deals with which one of the following? Options are format of balance sheet, format of profit and loss account, format of trading account or the format of cash flow. So this question is based on the Companies Act and its Schedule 3rd. Now the Schedule 3rd of the Companies Act 2013, it became applicable for all the companies who have to prepare their financial statements comprising balance sheet, profit and loss statement, etc. for financial years on or after 1st of April 2014. So this is not which is new, this is something which has been introduced for a while now. And when we open this Schedule 3 to the Companies Act, there are 3 parts in this schedule. The first part, it talks about the format to be followed for preparing a balance sheet. The second part, it talks about the format for statement of profit and loss. And the third part, it talks about the instructions while preparing the consolidated financial statements. So more importantly, we have to remember these part 1 and part 2. Part 1 is the balance sheet and part 2 is the statement of profit and loss. So now we can easily answer this question, and at Schedule 3 part 2, it deals with the statement of profit and loss. So correct answer will be option number 2. Now let's move to the next question. Which one of the following is not true? So here we are again being asked about the incorrect statement, and options are: when there is one liquidation and one formation, it is known as external reconstruction. Goodwill or capital reserve arises only when the amalgamation is in the nature of merger. Under the pooling of interest method, the transferee company incorporates the assets and liabilities of the transfer company at the book value. The vendor company transfers preliminary expenses at the time of absorption to equity shareholders account. So here all these statements, they are related to the concept of amalgamation and mergers. Now first important term which is being used in the question is external reconstruction. Now external reconstruction, it means the sale of the business of existing company to another company which is formed just for this purpose. So in this case, one company, the old company, it is being closed or liquidated, and another new company is being formed or set up. So old company is going and new company is coming. Now when we try to compare these 3 synonymous terms, amalgamation, absorption and external reconstruction, there is a very thin line of difference, and let's take a look at this difference as well. Now in amalgamation, it's very simple. Two companies A and B, they are wound up, and a new company C is formed to take over the business of A and B. So A and B, they have simply formed a new company C and they have been liquidated or wound up. In absorption, existing company A takes over the business of another existing company B which is wound up. So here A is taking over the business of B, and ultimately only A company is there which is left out and B company is closed. This is absorption. Next is a new company X is formed to take over the business of an existing company Y which is wound up. So in this case, a new company is being formed to take over the business of a closed company. So this is the case of external reconstruction. So here are these 3 cases, and we have to remember about these cases. Now another important concept which is used in this question is about the methods of accounting for amalgamation. Now whenever we record the transactions with regard to amalgamation, then there are 2 methods which can be employed. One is pooling of interest method and the another one is purchase method. Now when we talk about the pooling of interest method, in this method the assets, liabilities and reserves of the transferor company, the old company, they are being taken over by the new company at their existing carrying amounts or at their book values only. So here no change in the book value, the new company is taking over the assets at the same price at which they were being recorded in the old company. Now if any difference arises between the amount which is being issued as purchase consideration and the amount which is being taken over by the company, then this difference should be adjusted in reserves. So this is about this pooling of interest method, in which there is a merger of 2 entities and they are very much identical in different scenarios. Next is purchase method. Now under the purchase method, the transferee company, that is the new company, it accounts for the amalgamation by incorporating the assets and liabilities at either their existing value, or we allocate the purchase consideration to individually identifiable assets and liabilities. So this method is a sort of different from this one, and in this method, if any difference arises in the amount which is paid as purchase consideration and the value of the net assets which are being acquired by the new company, then this is considered as goodwill or capital reserve. So here there is a difference. In the first case, pooling of interest method, any difference was to be set off in reserves, but in this case the difference has to be transferred to goodwill or capital reserve. So in purchase method, the goodwill or capital reserve account is to be opened. Now next is about the accounting treatment in the books of vendor company or the old company which is being closed. Now for this vendor company, a realization account is opened in which all the assets and liabilities, they are transferred, and if any amount is realized by selling those assets and liabilities, it is also transferred. Now it is important to remember that fictitious assets, they are not transferred to this realization account. Rather, the assets of fictitious nature like preliminary expenses, discount on issue of shares, debit balance of P&L, they are not transferred to the realization account, and they are directly transferred to the equity shareholders accounts. So here, instead of taking them to the realization account, we are directly taking them to the equity shareholders accounts. So friends, now we can easily answer that the statement number 2 here is not going to be true, because the goodwill or capital reserve arises when the amalgamation is in the nature of purchase and not the merger one. So here option number B would be the incorrect one. Also, with regard to external construction, the statement which is made is very true, and about the pooling of interest method also, and with regard to the preliminary expenses treatment also. So the answer is going to be just option number 2. Now let's move to the next question. Personal transactions of the owners of the business are not recorded in the books. So this is an assertion which has been made. Reasoning given is, according to business entity concept, each business enterprise is considered as an accounting unit which is separate from its owners. So this question is based on the business entity concept. So if you understand this concept, then this is going to be very easy for you, and the statements in the options, they are very much similar as for any similar question. So let's take a quick look at the concept of business entity. So this business entity concept, it states that the transactions which are associated with the business must be separately recorded from those of its owners or other businesses. So we are not going to record the personal transactions of the owner in the books of his business. So this is what is being stated by the business entity concept. So this concept becomes important because if the transactions, they are being recorded in a haphazard manner, then this is going to create issues while reconciling. So now we can easily answer this question, that the business entity concept, it says that the personal transactions should not be recorded in the business books, and according to this concept, each business enterprise is a separate unit from its members. So here the answer is both A and R are correct, and R is the correct explanation for A. So 1 would be the correct answer. So friends, this was all about our discussion on 5 past MCQ series for UGC Net Commerce. Thank you friends. If you enjoyed this video, please like it on YouTube, subscribe to our YouTube channel and share it with your friends. If you have any query, you can reach us at hello@everstudy.in, or you can follow us on Facebook, facebook.com/everstudyclasses, or you can even join our Telegram group, which is t.me/everstudy, and the link of all these are given in the description of this particular video. So thank you friends. We'll meet in the next video.